What's up, guys? Will here, Secret Citrus on Profitly and Twitter. I'm going to break down a couple of trades I did this last week. Kind of the strategy I'm using right now in the options market. So basic rundown of the setup. I have the options chain, options chart, and the intraday chart on the actual underlying stock. Normally don't have this here, but just to break down the actual trades later, I'll put it there just for reference. Looking at the options chain, you have your ticker. You have your expiration dates that are significant. We'll go over that in a little bit. You have your calls on the left, your puts on the right, and your strikes in the middle. Things that I look at is the open interest. All right, total open interest. This is the number of contracts that have not been closed out yet. This is all based on the previous day's number. This is not updated live. This is updated at the end of every day. And then I have my total volume, right? I'm looking for big volume. Not only in the options, I'm looking for volume in the underlying stock, along with volatility. My expirations, you have weekly and monthly. I normally, when I play in the weekly ones, I'm normally in and out, on the same day. Not really looking to swing weekly options that expire that same week, unless it's like Monday to Tuesday maybe, because they decrease in value so quickly. If I'm looking to swing something into maybe next week, or I'm looking for a move that's going to take a few more days, I might take next week's expiration. And so I actually did one of each that I'm going to break down for you guys so you can kind of understand or see what I'm looking at. The further the expiration, the more time premium you pay. So they're a little bit more expensive, but you have more time for your trade and for your plan to move in your favor and to work out. So like I said, if you're expecting an immediate move, you take the weeklies. A little bit more risky, but more reward. You have your strikes in the middle. When selecting a strike price, you want to select something that's realistic in the movement that you're trying to take. You have in the money and out of the money. For the calls on the left, when you buy calls, you think the stock's going to go up. When you buy puts, you think the stock's going to go down. In the money calls, anything that the underlying stock price is already at and below, they're in the money. So they're more expensive. You're paying for time premium and you're paying for intrinsic value. Out of the money, you're just paying for time premium. I'm typically buying out of the money on both. I really only look for out of the money options, calls and puts. When selecting options to swing, you have to find ones like, for example, if I wanted to swing a play like I did with NVDA, I took a December 3rd expiration from last week, right? So I looked for two things. I'm looking for volume and open interest. I'm looking for the stock price, the strike price that I want, and I'm looking at the delta and the theta. So theta is going to eat away at your time. It's going to eat away the value of your option as the time decreases. And the delta, the higher the delta, the more your option increases in value when the underlying stock moves. So time decay, this is how much it's going to move when the underlying stock moves $1. Some things that I look at on my intraday chart is I have the RSI. This is a new thing that I'm using. It's a great tool to kind of predict, anticipate moves. Anything over 70 on the RSI is considered overbought. You could be looking for a downturn. Vice versa, anything under 30 on the RSI would be considered oversold, and I would be looking for a turn also. And I use the VWAP mostly with listed stocks. Something else that I used is overall market conditions. What are the main indices doing? I also use the VIX. It's an estimate of the future market volatility. It moves opposite to stock prices. So when the markets are all pulling back, the VIX is taking out prior resistance levels. Very key. They move counter to each other. And you can kind of use the two in conjunction with your trades. When you see the VIX is getting up towards resistance levels, one of two things are going to happen. It's going to break through, or it's going to reject them and then pull back down. Any major rejection off of key resistance is always going to be followed by a pullback of some sort. So that pullback is an indicator to watch the markets for a reversal and a bounce. And I'll go over how I use those two things in a couple of my trades as well. Implied volatility. This represents the expected volatility of the stock over the life of an option. And so Why this is significant is because it can create very, very expensive premiums. Let me fix these charts. Hold on one second. So as the demand for the option increases, the implied volatility will also increase. And this is what creates that massive jump in value. So options that already have high levels of implied volatility, they are going to result in higher price premiums. That's why it's important to take strategic entries based off of support and resistance. You're not going to buy something at the top because the option is already calculating in the implied volatility. A perfect example would be, Rivian. It IPO'd. A few days later, options started trading, and the premiums were just through the roof. You had massive swings in the stock, but it was so expensive to trade the options. The risk reward which really wasn't favorable, and that's one, example of how that volatility is already calculated into the option price. So being able to predict the big swings, being able to see when something's topping and when something's bottoming is very strategic. So you get key entries on sale. And so that's why you're going to enter at support to minimize your risk. Your risk reward is always key when you're making any type of trade with, derivatives or equities. You're going to sell into strength. You're going to sell into the resistance levels. Or if the stock's going against you, you entered at a support level, whether it be long-term or intraday, you're going to cut your losses. 9 times out of 10, you should not have a risk much lower than your entry because you're basing your entries off of support. You're basing your entries off of what potential moves that you're predicting the underlying stock to make. So you're going to see that the entries that I'm going over, or that I'm going to go over, are based off of support and resistance levels on the long term and the intraday chart. And I'm never going to buy anything I'm going to size into my positions. So I'm almost never going to take a full position size in one single trade. I just don't think it's very smart. I think it's better to size into your positions as your conviction gets stronger. I don't swing weeklies unless it's the beginning of the week and I'm anticipating a significant move. Or I'll swing the following week over the weekend. Let's say it's a multi-day runner. Friday's the first red day. I might take puts on a bounce into the close, swing that over the weekend, anticipating a gap down and more backside. And then, you want to lock you'll see when I go over my trades, you lock in your gains. The same way you don't enter all at once, you don't have to exit all at once. You can sell gradually into strength. And you have to stick to your plan, You stick to your trading plan, and your trading plan includes an exit strategy. So you ask yourself, as you're watching your play form and play out, is your plan still intact? When you recognize you're wrong, what are you doing? You already entered at support. You knew your entry was your risk. You have to stick to your plan, and you have to cut your losses. The options will go against you very, very quickly, and in a matter of minutes, you could be down 50, 60, 70, 100% of your entire position, especially if you're playing weeklies on a Friday. And today, they all pretty much go to zero. You never hold options through expiration. Only trade options that have massive volume in the option and underlying stock. And we're looking for volatility in the underlying stock. So how do I find options that are potential options trades? I'm looking for recent runners, hot sector, breakouts on the multi-month, multi-year. I'm looking to take realistic strikes into all these depending on the type of move that I want. The most important is I need volatility in the underlying stock. That's what's going to create the big increase in option value. All right, so we got about 5 minutes left. We're going to break down a couple trades. All right, I took NVDA puts long on the bounce into the close on the 24th, right? Thursday was off. There was no trade on the 25th. I sold it on the 26th. So Monday and Tuesday, the market showed me very key things. Gap down, followed by a bounce, and more downside. Tuesday, gap down, followed by a bounce, more downside, right? Wednesday, same thing happened, but the market's kind of closed, or NVDA kind of closed near its day highs on Wednesday. But the VIX had just taken out prior resistance levels and was holding it into the close. So I took a starter position. I bought 100 shares, or excuse me, 100 options, 100 put options, 300 strike with the following week expiration. Gave myself some time for it to play out. The next day, it ended up gapping, it gapped down massively pre-market and then started to bounce. So we see the 24th is when I take my position. You know, the market gapped down and bounced, and it pretty much held throughout the day pretty well, you know, above 325 in that range. But I look back on the intraday, like, what is this range? There is significant resistance in this range. It's 325 to 330 range. You know, it hasn't proven itself to hold. So when I see gap up, you know, on the major breakout, and then this is when the panic started to ensue in the markets, pull down, same thing on the 23rd, gap down pre-market, little bounce, gap down, and the same thing happened. So I'm going into November, right? Or excuse me, the 24th of November. This is the Wednesday. I see the same thing, the gap down and the bounce. I'm like, okay, excuse me. Yeah, pre-market gap down. And it started bouncing. And so I see right here, I entered literally at the end of the day, like a few minutes before close. Because I'm thinking to myself, risk reward is favorable in this trade. The overall markets are pulling back, I think. And then you have the VIX that's taking out resistance levels. I think this is just going to fade. So I take a starter position. I bought 100 contracts. Next morning, it gaps down. Right? Into that gap down on when it opened up. Where are we at? Okay, here. This little bounce right here. This little bounce early morning. It's a short day. Market closes at 1 o'clock. I added 50 shares into this bounce, right? Into this dip. Added 50 more shares, and then I rode it for, you know, an hour or so, and then I sold it. I literally sold it on the way up here, here, and here, and I got out at an average of like 387. Sold it into strength. I could have swung it longer. There's probably way more downside, but why take the risk over the weekend? You know, you're already sitting at 85% win, massive gains, great execution. You know, zero complaints here. So you see why I entered the indicators that I was using. Overall market conditions. The VIX was taking out resistance levels. And I entered at key resistance. That was safe. So if it went against me, I could very easily get out. But I'm not going to enter mid-range. You have to be strategic in your entries and your exits. And then you have to sell it into strength. All right, second trade of the weekly expiration, lottos that I took on Friday towards the end of close. I took Tesla, traded Tesla 3 times on this day, smacked all 3 of them perfectly. It was beautiful. But I'm specifically going to go over this one because this was a more risky strategy, but an example of how I would play like a weekly lotto call going into close or at any time on the day. I took puts. So I scalped the high of the day rejection on the weekly lotto, sold the trade. Could have made 3. I could have 3x'd it, but why take the risk? I mean, I locked in 89%. Smaller position size because I have way more risk taking the weekly expirations. So with this one, it opened up massively gapped down. Right when I saw it turning, I also saw the VIX get rejected off resistance. I saw, okay, the market's going to bounce a little bit. So I bought the calls, took it up. Vice versa, bought the puts, took it down. And then I was waiting, it kind of grinding all day, and I was really just watching the VIX and seeing how the overall market was going to work and the direction it was going to close in. And I saw the VIX, you know, starting to take back off. And so I took some puts here, small size, and I literally I took the last week expiration, so the chart's not there. But this move from, you know, where I entered at like 1097, 1098, all the way down to, you know, 1081. This was a 250% increase in option volume or value. And it ended up being a perfect execution. for the type of trade I was trying to do. I was only trying to take the lottos anyway, so I knew I was going to take this and just sell it like pretty much. I'm pretty sure I sold it right here on this. And this little 196, 190. I saw, yeah, I got in at about 196, 197, and I literally sold it like right as it cracked 190. It was like 189, 190 when I was selling it, and you can just see what the weeklies did and difference in the value of the option. I mean, it went up 250%. But I mean, I was locking in gains. I wasn't trying to be greedy because those are the type of plays that can really bite you in the butt if you're not playing it right. So different indicators that I was looking at the VIX towards the end of the day. I literally took those calls, or excuse me, those put options around noon. If you look here at noon, what started happening? Right here, around sometime between noon and 12:30 is when I took those. I can't remember the exact time, but it bounced. The VIX bounced off of this same intraday level, and it started to turn back up. And I'm like, okay, this is going to go up. That means the markets are going to close, near lows, is what I'm anticipating, and that's what happened. And so, as soon as this thing started to turn, everything else started to turn the opposite direction. It was so predictable. I'm not saying it always works, but when the markets are showing you something, you have to respect what it's showing you. And they're showing me that they're weak. They're showing me that they want more downside. And they're overextended. It's been overdue. Whatever is causing this, they're blaming it on COVID, whatever the case may be. It's really irrelevant. You play what it shows you and you stick to your trading plan. So I bought it here, but really I'm risking, I say that's not a lot, but with 197 to the day high or around 107, I mean, that right there will take your options contract pretty much to zero if it were to keep going up. So as soon as literally my entry was my risk. I entered when I saw the weakness in the overall markets, followed by the bounce and the VIX, and I thought, okay, we're going to close down. I thought this would be a very predictable and easy win. I ended up taking this little meat of the move, and this little meat of the move was 80-some%, but this was 250%. So just another indicator. I am a student of Tim Sykes. I am in his Millionaire Challenge lifetime membership. Highly recommended if you are trying to get into trading to learn fundamentals, the basic. He's an excellent trader. Excuse me. Yeah, but he's an even better teacher. And so a lot of great assets in joining this program. If you're interested, just go to the site and you can look at it yourself. I'm also a member of Mark Crook's Evolved Trader. This is where I learn to trade options. Appreciate you, Mark. But the bottom line is no good trader got to where they are at by themselves. If you want to be successful, you have to learn. And the only way to learn is to associate yourself with other people who are knowledgeable, who are already proven themselves to be successful in this. Because most traders are not successful. They're not consistent. They don't make money. 2 years, you already see where I'm sitting at. Can't wait to see what the future holds. I also joined a couple new subscriptions. I joined because I want to really focus on my options trading. I joined the Unusual Whales, and I've also joined exclusive trading just to, try to see what other subscriptions are like and grow my overall knowledge account. If you like the video, go ahead and comment, like, share, subscribe. Subscribe to follow my Twitter. I post a lot of stuff here also, what I'm thinking, what I'm trading. Hope you guys enjoyed the video. Have a great day. I'll see you guys on Monday.